Over the last couple of years, more and more publicly listed companies have jumped on the crypto-treasury bandwagon, holding BTC, ETH, or other crypto assets on their balance sheet. The trend started with MicroStrategy in 2020, and now companies like SharpLink Gaming, Bitcoin Immersion, and MetaPlanet from Japan are following suit. These companies raise funds through things like equity offerings or private investments, then use that cash to buy crypto. So the idea here is simple. Investors see this as a way to get exposure to crypto without directly owning it themselves. Plus, there's the promise of things like staking yields on ETH, typically around 3 to 5% annually, or some small cash flow from the company's operations. When crypto prices are high, this strategy looks great and it could lead to massive gains. But here's the catch. Many of these companies are what we call zombie companies. They are barely staying afloat, relying on constant cash injections just to survive. They might be selling equity to buy crypto and using unrealized gains or staking income to cover everyday expenses, but they aren't really making money from their core businesses. This sets up a dangerous balance. As long as investors are excited and crypto prices keep climbing, everything seems fine. Capital dilution funds growth and staking rewards cover burn rates. But if the market takes a downturn, the risk gets huge. For example, if they have opted for convertible bonds instead of equity, the situation gets worse. Fixed debt obligations could trigger defaults, margin calls, or forced liquidations if crypto prices fall too much, breaking key financial rules like debt-to-asset ratios. Lenders could demand early repayment or penalties, which could force these companies to sell crypto at a loss to fix their balance sheets. In other words, we are essentially trusting these crypto treasury companies to manage the debt-to-asset ratios responsibly. Right now, a lot of firms are riding the MSTR play wave, and if they get too reckless with that, things could quickly spiral out of control. Just one over-leveraged zombie company collapsing could start a chain reaction. It could scare investors, cause share price to crash, stop capital raises, and force asset sales that drive crypto prices even lower. Experts like Lynn Alden have pointed out the risk, and even Vitalik Buterin himself, the co-founder of Ethereum, weighed in during a Bankless podcast interview in August 2025. He said ETH treasury companies could be good and valuable by giving people more ETH exposure and helping adoption, but he warned that if firms borrow too much, it could turn into an over-leveraged game. So companies mix equity and low-cost debt to manage their ratios carefully. For these companies, it's a calculated bet on crypto prices rising, but many others don't have a solid plan and are just riding the crypto hype. If the market turns bearish, they could be in some serious trouble. So in this video, we're going to take a closer look at how MicroStrategy has managed to stay successful, compares it to riskier newcomers, and highlights the dangers of this model. If you like this type of deep dive videos, make sure to give me a thumbs up and subscribe to the channel because there will be more videos to come. Alright, so many people are drawing comparison between the current treasury company's hype and the dot-com bubble. Even though the internet tech was valid, it still crashed in the 90s due to overvaluations. As for the current treasury company's trend, even though I have no idea how long this bubble gonna stretch because it can take months or even years, if companies don't keep the ratios in check, a market downturn could expose just how fragile everything really is. But first, let us look at MSTR or MicroStrategy first, the one and only that started this trend. Strategy MSTR kicked off its Bitcoin treasury back in August 2020 when BTC was around $11,000 per coin. By Q2 2025, the company held 628,000 BTC, acquired for a total of $46 billion, or about $73,000 per BTC, giving Strategy huge unrealized gains and about 3% of the total BTC supply. So why has Strategy worked? Well, I'm glad you asked. It comes down to 6 main reasons, so I'll break it down for you. First is the brand itself. The CEO, Michael Saylor, is a huge crypto evangelist, and his narrative has built a loyal following. This has allowed Strategy to trade at a 2.5x premium to its NAV or net asset value at some point throughout 2024, meaning investors are willing to pay 150% extra for the leverage and management they offer. In other words, the CEO himself has basically built a cult. Second reason is the capital access. Strategy raised over $10 billion in 2025 through equity offerings and convertible bonds. The company's $128 billion market cap helps keep its costs lower. Coming number 3 is the low-cost basis. Strategy's early BTC buys give it a cushion against price swings. Newcomers, however, are buying it at prices above $110,000 per BTC. If the bull market continues, maybe it's reaching $150,000 in 2025, I don't know, these newcomers could benefit, but only if they manage it well. Number 4 comes down to its conservative debt strategy. So the company has taken a more conservative approach when it comes to debt, balancing convertible debt and equity. This keeps its debt to net asset value ratio around 11% as of Q2 2025, with $8 billion in debt versus $72 billion in BTC assets. The beauty of the convertible debt is essentially deferred equity. There's a low or no interest, no collateral tied to BTC, and no risk of margin calls. If you have no idea what convertible is, go back to my previous MicroStrategy video where I explain all the core concepts, link on the top right corner. Another reason that leads to Strategy's success is the legacy revenue buffer. So Strategy's software revenue, about $114 million in Q2 2025, with a $78 million gross profit, helps cover operations without even needing to sell Bitcoin. This was a lifesaver in 2022 crypto bear market. On the other hand, zombie companies don't have this buffer, though ETH staking could potentially fill that gap. And moving on to the last reason behind MicroStrategy's success, kind of circles back to what I mentioned earlier. They don't use Bitcoin as collateral unless it's an absolute emergency. They proved this approach works when they avoided selling any BTC during 2022's crash, which kept their entire position intact. And because of the size of the holdings can influence market sentiment, sticking to a strong hodl policy is a big part of their strategy. However, for newcomers, what works for MSTR might not work for them. Lots of newcomers in the crypto treasury game are basically what I call zombies. These are companies losing money every quarter but still buying crypto, usually by selling shares which dilutes existing investors or by issuing convertible bonds which piles up debt. Sure, selling shares can keep them alive for a while, especially if they use staking rewards to help cover expenses. But taking on bonds, that's risky in a downturn with all the covenants and repayment deadlines hanging over them. Sure, in a bull market, they could make big gains, but if they get carried away and start buying just because of FOMO, things can spiral fast. Even though ETH-focused companies can earn staking yields, they'll hit liquidity problems if they need to unstake in a hurry. So, since BTC and ETH is such a big trend in this cycle, why don't we now look at some examples and some of the companies that are opting this play? The first example that we're going to look at is a company called SharpLink Gaming. SharpLink used to be a gaming company, but in June 2025, they went all in on Ethereum. By the end of July, they scooped up 438,000 ETH, about $279 million worth, using money from selling shares, not profits. They have made 722 ETH in staking rewards so far, but here's the problem, they are still a zombie. Q1 2025 revenue was just 742,000, down 24% year over year, and they lost almost 1 million. In 2024, they made 3.6 million but lost 4.5 million. They are burning cash, relying entirely on ATM equity, selling 44 million shares in July alone to raise 852 million, which is roughly 200 times their annual revenue. No debt for now, so equity is funding the ETH buys, and staking yields of 4 to 5% APY might keep the lights on. But if a bear market hits in 2026, It's anyone's guess whether those yields will be enough to keep them afloat. The next company we're going to look at is called Semler Scientific. It is a company that sells a healthcare product called QuantaFlo, but now they are also stacking BTC. As of July 2025, they hold 5,000 BTC, worth about $586 million, but their core business is shrinking fast. Q2 2025 revenue was just 8 million, down 43% from last year, and they lost 2.1 million on operations, only showing a profit because of BTC gains. They're keeping things running with $100 million in 4.25% convertible bonds due 2030, plus ATM equity, selling 7.3 million shares to raise about $320 million. Equity is covering costs for now, but those bonds are a big risk. If the market tanks, they could break the debt covenants like debt-to-asset ratios, which bondholders would have the right to ask for earlier repayments. Though the healthcare angle gives them some differentiation from other dozen of copycat treasury companies, bad management could still send this thing off a cliff. This is also coherent with what Vitalik talked about in the Bankless interview. He supports ETH Treasury as a way to access more exposure, but warns that over-leverage could destabilize the market, similar to the lunar collapse. So basically, his word of advice is to be cautious. MicroStrategy can pull this off because they keep it tight. Low leverage, steady revenue, no collateral, and a strong brand. For zombie companies to survive, they'll need the same discipline. Equity sales and sticking yields might keep them afloat, but taking on bonds, that's like playing with fire. So the bottom line is, this crypto treasury boom shows cryptos is going mainstream, and MSTR strategy has worked so far. But zombies and unhealthy companies are taking big swings with equity-funded buys and sticking rewards. If they don't manage their ratios, they are one bad market away from a mess, especially with bonds in the picture. If 2026 turns bearish, the cracks will show, just like the one we had in the dot-com bubble. It's basically musical chairs. You don't know who's going to blow up until the music stops. Personally, I just own BTC or ETH directly. No dilution, no messy governance. The treasury story is fun, but you've got to play it safe. That's it for today's content. See you guys next time.